Until early October, 2022 has handed in a fairly hefty U.S. stock market correction. 2023 is the forward look now in terms of stock market fundamentals like earnings and revenue growth, maybe even partly 2024 at this point, but is what we're seeing reflected through the stock market an anticipated recession? That's the question that our chief equity strategist and economist, John Blank, will have the answer to, hopefully. John, how many past recessions has the stock market predicted?
It's actually a decent forward indicator, but it's not a very accurate one. I don't know the exact facts, but it's certainly no more than half.
So you say that during some past recessions, the stock market actually rose.
That's correct, because what can happen, as we talked about just a second ago, is the stock market's a forward indicator of future earnings and growth, not the current status. And it looks out forward, 6, 12, 18 months. That varies too. But for example, right now we're talking on the 27th of October, I got 19.5% down on the S&P 500. At the same time, I have to look at the 10-year Treasury, because that's what the Fed funds rate is reflecting. It's now down to 3.93%, down 7 basis points today alone, below 4. So why is that? Well, the market's starting to see some latest indications from the GDP report this morning that the prices in GDP, which is, by the way, what the Fed cares about, were falling dramatically, which means that the Fed may pull back on rate hikes in 2024 now. That's what the 10-year is telling you. So you always got to stay tuned to this idea that, basically we're pricing in a future, not the moment.
What are your top-down 2022 year-end stock market signals? Targets, I should say.
Yeah, I would be around 4,000 to 4,100 on the S&P at the end of the year, and I would be around 43 to 4,400 next year, meaning 10% annual returns. I think a lot of what's going on is just getting back to mean reversion here, and that's not a real deep insight, but I think that's the best one to go with.
In terms of the economy, should investors be worried about 2023 based on current market activity?
Look, the Fed is trying a soft landing, and all the consensus estimates that I see are for a recession in Germany, possibly Italy, I would think the UK. So Europe is in a situation that's a little more dire than ours, but not real dire. And then for the most part, U.S. growth rates for next year are at the 1% level. So the market hasn't given up on a soft landing yet, and I don't think people should, because we have such strong labor markets right now that it's very difficult to see how the labor markets roll over and create the unemployment that really tanks the economy in a cyclical way at this point in time.
Should investors maybe even be more focused on taking advantage of bargain hunting, or is it still too early for that?
Yeah, in a measured way, you certainly should be in the market, particularly after midterms. There's always a midterm run from the October period on in midterm years. So yes, you should be, being bullish because the market is cheap, and you make money as a standard person in markets when they're cheap.
We're in the Q3 earnings season right now. According to published reports, the strength in the U.S. dollar is expected to cost S&P 500 companies $15 to $20 from their EPS. While companies may be able to hedge against that, is there any way for investors to hedge against it?
I don't think so, Terry. I think that's a simple answer. I wouldn't bother with it. It's probably priced in.
Okay. Is investing maybe in small cap companies a way around that?
I think absolutely mid-cap and small-cap companies are at a historic low price-earnings ratio. And again, just because they're so cheap, as you've got the time horizon as an investor, not a trader, you should be picking these names up. And just to understand that, when the things toggle around here the next 6 to 12 months, just keep your measured allocations to the small and mid-caps, and you're going to make a lot of money long-term.
And now that we are in the thick of the Q3 earnings season, do you see a downgrade in the earnings outlook dampening the attractiveness of equities?
Not really. We're seeing, historically weak beats and raises, but it's not so historically weak that it's out of proportion to what people are thinking. I would say given what we've seen and given what people's pessimism was already in place, it's probably been an upgrade from the deep pessimist to something that's sort of in line with, a modest pessimism.
3 stocks you've been watching include the Southern Company, Valero Energy, and Fortnite.
Yeah, Southern Company is an interesting one to talk about, Terry. This is a big utility in the South. I've got it at $66 a share right now. And what I've noticed is it was $80 a share not more than a few weeks ago. So you got a nice entry point right now because of the sell-off in this name. You can't go wrong with a utility like this if you're looking for yield. It's 4.1% right now. So if you're looking for yield, I like Southern Company.
And Valero Energy?
VLO is an interesting stock, Terry. This is a refining company. They are based in Alaska, but they do a lot of business down here in California. And this stock is doing really well the last month and a half. It topped down at 100, moving up to about 130 now. I've got a high, 52-week high at around 146. So I would like this stock up for another 15% move. If it breaks that 146, you have the traders will move it on the stock and push it even higher.
And Fortnite.
Fortnite's a great name. People should know about this name. It's a big, large cap stock in the security, computer security space, which is never going away. As far as I can tell, most of these stocks are very high PE ratio stocks. You're not going to get a good price out of this. But right now, Fortnite's $50 a share, and it was $70 a share back in December. So this stock did pull back with all the other tech stocks, but it's in the space that's probably going to get a bid and stay alive for the next 3 years. So you got to like Fortnite.
Our chief equity strategist and economist, John Blank, looking at whether the stock market is predicting a recession. With John, I'm Terry Ruffalo. Here's something you may want to check out. A just-released special report, 5 stocks set to double, where 4 Zacks experts each announce their single favorite pick with the potential to gain more than 100% in the months ahead. Get more details on this report at zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.